In this video, learn how to stop frustratingly turning a winning stock trade into a losing trade.
Hi, I'm Mike Bellafiore, co-founder of SME Capital, and we're a proprietary trading firm located in Midtown Manhattan. And I'm also the author of the trading classic One Good Trade and the Playbook. Click our subscribe button so you don't miss any of the videos that we're producing for you in the trading community.
See how a junior trader creates an anti-playbook trade to help eliminate his bad trading and bad trades, in this case turning a winning trade right on the open into a loser that are holding him back as a trader. Let's get to work.
Today I'm sharing this anti-playbook on a trade that I do quite often, and there's portions of it which I'm looking to work on. It's the opening drive to the short side. So the setup at its core it's an opening drive play. It's a consistent pattern throughout these trades that I've been recognizing, causing me to take losses pretty frequently. The one bad trade, the anti-playbook, is made on the follow-up, the second attempt to this opening drive short. It's the second leg, where instead of following through with what the original setup was, that momentum trade to the downside, it ends up turning into a different trade altogether, increasing size while there are reasons to exit, telling me to get out instead of increasing size. The original setup is a short position. It's based on first the planning, so it's anticipating a sell-off in the stock right near the open or during price discovery. And this is due to one of many reasons. These examples, it can be a gap down with a strong negative catalyst that may show me that off of the open we might see a strong sell-off. So I'm going to get prepared for it. There could be some news event or changing fundamentals where there is a huge gap to the upside, and maybe I'm viewing this piece of news as a potential overreaction and looking to see if there's going to be a sell-off on the open. And in general, just planning for a trade, no matter what the catalyst is, if there's going to be this sharp sell-off, to look for confirmations off the open for potential entry. These confirmations can be recognizing strong selling on the tape, seeing just consistent offers stepping down, driving the price lower, the bids failing to be able to support the price at whatever level it's trading at. And also there's this price action which can just reflect lower highs, lower lows, closing at the bottom of the candles. There are many confirmations that can show that there's just clear, strong selling outflow in the stock. These three examples are opening drive plays where I'm looking at the sell-off and I'm recognizing whether it's the price action or the tape. For some reason, in each of these trades, the position is being opened up as a short in an attempt to capture this momentum to the downside on that original sell-off. The three arrows that I'm pointing to are spots where instead of seeing what's happening develop on the chart or on the tape, instead of me taking off risk or getting flat, I'm instead adding to this position. And this is a practice that I'm going through in this playbook as a bad practice and a bad trading habit that I would like to try to minimize.
So basically you're turning a trade that was a winning trade into a losing trade. Is that a fair assessment?
Yes, exactly.
Okay, so when you're in the money, is it mostly an issue of you not taking off winners and trying to make too much? What's the root cause of all of this?
I think the root cause of adding to the position once there is a confirmation in the opposite direction, instead of taking off risk or getting flat, is that the confirmations leading up to me actually entering the position. And then once I enter the position and it's proven to be right as it continues in the direction to the downside, that continuation after I already entered is just another confirmation where I feel, okay, I got ready for the trade. I wanted to see XYZ. This happened and now it's continuing lower. If there is a bounce, I'm not taking it in quickly enough to say, which I should be, that, okay, this is a confirmation in the opposite direction, but rather I'm looking at it as a way to say, oh, I got lucky that the price bounced and now I can enter in for a second leg lower. I try to exaggerate the wins. I see that it's going in my favor and that if something has gone against me, if the price has gone against me for a moment, that I can just exaggerate the win that I already had, the amount that I was in the money. Now I just have another attempt to be able to add on to this. Once we were at the lows of that opening drive, I think that we can get back there. And so if we're only getting back to that level, I don't think that being right deserved that small of a gain, and that I want to, as I mentioned, exaggerate, add on to these positions so that once we do move back down to that level, the amount gained, the return, will be quote-unquote worthy. This is a bad way of looking at things, but it's part of the psyche that I'm trying to get rid of, which is attempting to have these gains be larger than than they were in the first place once I was proven right. I'm expecting that I can get this move back down to where I was. I would like it to be larger than it was the first time, and this is just a bad habit altogether, and it's a bad way of looking at things and setting price levels.
If you want to learn 3 real-world setups that our traders use, including the simple setup that we teach all of our new traders and the setup that turned one of our traders into a 7-figure big money earner, check out the free webinar that we're currently running. Just go ahead and click the link that should be appearing right now at the top right-hand corner of your screen. That's going to open up this free registration page in the new window, so don't worry, you're not going to lose this video. You're going to learn more in a couple of hours from this trading workshop than from years of online education.
Yeah, I mean, are you sitting there saying to yourself, well, I was up $1,000, just to come up with a hypothetical. Now the stock bounces, you're up 600. Does it bother you that you're now not up $1,000 still? Is that at the top of your mind? Is it something different?
It is. I wish I could say it wasn't, but it definitely is. That number that I was at whenever the highest return that I had gotten, if it's starting to move against me, and this is happening really quickly, then I think I'll wait till we move back lower.
So you actually, I'm guilty of this as well. So you actually are saying to yourself, instead of being up $600, using the hypothetical I drew before, you're up 1,000, bounced on you, now you're up 600. Instead of you thinking you're up 600, you think you're down 400. Is that fair?
That's fair. In this specific trade style, yes, at times.
Okay. Do you feel like you can do a better job determining in real time when to take off going forward? Or do you feel like you're just not quick enough and this isn't something you really can get better at in the near term?
I know I can improve on this. This is a part of a set of rules I set out to avoid trading on tilt about a month and a half ago, 6 weeks. And I think going forward, as long as I can recognize that that's a bad way of looking at things and following the rules that I've set, that I can fix this going forward.
Are you doing mostly swing trading? Are you doing mostly scalping? Where are most of your winners coming from?
Towards the open, it's mostly scalps throughout the day. Doing a lot of majority of my trades, I would say, are breaking news trades to scalps. But I do have a mix of entering in early on and holding for a few hours.
Okay, so this is more important for you to get this right then. So if you're doing more scalping, you're going to have to think quicker and recognize faster when it's time to take off your scalp for these opening drives.
For example, the first example listed here, do you see that as a way where once it reaches my initial entry, that is that time where I should know there's a change in character, or is it the very first bounce?
Well, when I see that Gillett chart, what I see is a steepness, which you could develop into a rule, which could bring a trade decision as to get flat. When you're scalping, when you're momentum trading, it's super important not to let the stock go back against you. That's the essence of really good momentum trading and really good scalping. Really good momentum trading and really good scalping is you are short when the stock is going down and you're long when the stock is going up. And I'm not trying to be cute about that. I'm not trying to make a joke about that as if trading is that easy. That is really what momentum trading and scalping is. It is you being good enough to be short when the stock is going down, and when it starts to go back up, you're out. You take your profits, you can see where to take your profits, you're out, and you start over and you look for the next trade. Really good scalpers in an opening drive play, in their playbook will have that good short, and they're good enough where not only do they have that good short, but they're flat, take their profits, and then they get long a little bit for some pretty good longs. They're going to have, particularly when something gets too steep, they're going to take the profits into the steepness at a really good price, and then they're going to get long a little bit into that bounce. as opposed to what you're thinking about doing, which is not taking the profits and then adding into the bounce. Like, that's not momentum trading, and that's not scalping. That's the essence of sort of swing trading, which is fine. Which is, there's a lot of really good scalp traders, swing traders on our desk who trade differently, who are making multi-day plays. And when you see the steepness on the open, when you see that opening drive, that isn't going to be a signal for you to get out of your swing trade. It may be a signal, it probably is a signal actually, where it's confirming you're right, and then you are going to short into a spike, into an up move, wait for a turn, add some size to it, and then play for a lower move. But not for momentum trading and scalping. And that's why we go through these playbook trades. That's why we ask you guys to build your playbook, is because you have to understand the trade that you're making. The trade that you're making has rules, it has a strategy behind it. There are time-tested things that work and don't that we need to point out to you. Okay, so that's why I asked that question. Scalping, momentum trading, opening drive play is not you holding into the bounce. It's you getting the heck out, taking your profits. You did a great job. You found the right stock. Very hard to do. You found the right stock. There's all these stocks to trade. You found one of the best ones that had a huge move to the downside, weaker than the overall market. That's a terrific job by you. Okay, and then you got in it. That's super hard too. Most people can't do that. And then you held it for at least a good period of move. Most people can't do that. Really what we have is just one thing that we need to fix. I'd actually argue two. One thing being your exit strategy, and two things being your mindset of taking these trades a little bit quicker and being more mindful not to hold these things against you, because that's a different trade. And if you want to develop swing trades, then we'll have another conversation. We'll have a completely different conversation. But as you explained it to me, momentum trading, scalping, opening drive plays, we don't want to be in the up move when our initial entry is short. Okay, so hey, great examples right here. Could we go through the primary example that tipped you off to this is something that you need to work on? Could we go through that in detail and then talk a little bit more about it?
So the original entries on this trade are based off of recognizing that there's an opening drive to sell off to the downside. As you can see on the volume bars below the chart, there's consistently a much larger composition of that bar made up of outflow, which is hitting the bids, which is just showing that there are aggressive selling rather than aggressive buying. And this is true throughout the entire morning. So with these confirmations, opening up a short in front of the low of the day, also where there's been a recent bounce and consolidation and holding near, which is this first arrow. And then once there's a bounce and it's immediately sold back off and a new low of day is put in, adding to the position on the short side. So here's where I go wrong, is the bounce and when there is a change in that momentum. Covering into the momentum as this inflection was reached, the 72.50 was an inflection point, which was hit, and then there's an immediate bounce. We see the price moving to the upside, and this shorter term moving average was broken through. There's a change in character, and in front of that, which is right around a little bit below 73, is where I decided to cover half of the position, with the anticipation that we're going to move back down into 72.50, move lower, and I would be able to cover the rest beneath that level. Instead, we actually get a bounce which breaks that shorter term moving average. On this first large green bar right here, we see that the recent breakdown level of 73.50 is now reclaimed. Now the first breakdown level, which allowed me to enter, that is being reclaimed. And lastly, we get back up to VWAP. Weak stock, I know Bella mentions quite often, weak stock with extreme weakness, we're not likely to see a stock retraced from this extended beneath VWAP all the way back to VWAP if it is truly weak. What I had done during this trade was I allowed this to go all the way against me, just back up to right around where I got in, and actually it touched VWAP, which showed me that I allowed all these confirmations to go against me, to give me a reason to exit, to show me that, okay, here's where you need to exit the trade.
Look, if you're making momentum trades, you're making opening drive plays, you're making opening drive scalp plays, how do we get out into the flush into 7250? How do we create some rules or drilling down into the tape, the level 2, that gets you, and I'm not suggesting you have to take out literally the bottom, but your goal should be to get out near the bottom. That is something that we can do as active, skilled intraday traders, looking for something that's too steep, that stops to go down on our tape, to recognize that it's not going down any further, or to use maybe a technical level to trade off of. That's a big consideration as well. And then that really is your job, Jake. That really is your job. That really is the standard for elite opening drive scalps, elite opening drive momentum trades, is you being able to get out near that 7250-ish area. That really is the standard. And then, as that goes back up, where you're thinking about adding, you thinking about making a new trade. And I'd actually set a higher standard than that. Your standard is being able to get out near that 7250-ish area, being in it for some of that up move into the 74 area, and then and adding that to your P&L. That really is the standard. And then if you're going to be scalping on the open, and then considering a new short where you wanted to add to your original position. So these are really 3 trades, and you are trying to make one.
Yes, it does. So this playbook, just to wrap things up, it was created off of an opening drive short, where instead of recognizing that there are reasons to exit, using those reasons to exit, say the bounce, for example, as a place to add to the position, to increase size instead of getting out or taking off risk. I spoke about potential rules that I have in place to be able to avoid, one, trading on tilt in general for this type of strategy, and as well as just avoiding this going forward, this specific example. Once I'm in the position, once the price target or a price target has been met, or there's been a significant move in my favor, the price bounces and there's a new level. I think going forward, I would like to see if this can help by, as you mentioned, Bella, getting flat, exiting the position, and reevaluating, rather than just jumping, adding size and continuing and looking for the continuation play. If I'm uncertain, I think the best way to go about this would be to actually get out of the position and reevaluate. Another rule that I have is going through my trader view, going through the stats on trader view, and looking at what a normal position realized profit, or MFE, max favorable excursion, would be. And if that level is reached, if I've made that much on this play in the first try, don't let it trade back to break even, especially past break even. So if I get to this level, I think that would be somewhat of a trailing stop, where if I'm up, the average trade that I make, to be able to use that as a way to say, this is where my new stop will be. Or if I can reach this level, to have break even at the very least to be the final stop, not letting it go negative if I've been up and had an unrealized P&L of that much. So I'm going to be using these 3 different rules to be able to see which works best for me, and if I can see some change in the way that I trade. I've been using the intervals of average trade P&L to be able to place stops and price targets. If I'm up a certain amount in a symbol, if I'm up a certain amount on the day, or down, per trader view statistics, to use that as a way to, as Ryan always says, not overstay my welcome, not push for too much more. So it's a mix of being able to, in real time, use the trade, and if there's a change in character, to, instead of add to the position, to get flat, reevaluate if there is the reversal trade, or if there is just no reason to continue trying to get more out of this stock. Other portion of the risk rules to avoid tilt, which is if I am up a certain amount, which that interval is based on statistics from TraderView, to not push it, for lack of a better term, and using those intervals to know when to take a breather.
Yeah, that makes a lot of sense to me, and that's excellent thinking right there. We have a problem. We have an instance of underperformance, and look, you're doing so many things right. You're doing so many things right. You're really just doing a little bit that needs a little bit of tweaking. Doing so many things right. So this is very fixable. Adding on to all those things you're doing right, a solution, some solutions, will make a huge difference. And this is an excellent way, a bunch of new guys joining us today, this is an excellent way how we think through our underperformance. There's gonna be things that we need to do better. We're all trying to do better every month, every week, every day. It's the start of the new month. It's a great opportunity for all of us to improve, all of us, top to bottom. The way we do it is we understand what we do well, we do more of it, we do more of that bigger. And then with this exercise, we cut out the stupid stuff. We cut out the underperformance. We cut out the stuff that's very frustrating and holding us back. And it is very frustrating to see a trade where we're really winning and we're making a lot of money, and then get into a situation where we give back those winnings. That's very frustrating. So we want to come up with a solution to keep more of the profits and to improve our results. And that certainly does, that certainly will significantly improve your P&L. Jake, I appreciate you running through this detailed review with us. Look forward to you implementing those solutions and seeing some better results with this type of trading.
Hey, go ahead and click our subscribe button so you don't miss any of the videos that we're producing for you in the trading community. And please take the time to add your feedback in the comments section for what videos you'd like for us to produce next and what you found helpful from this video. From all of us at S&B, train and trade well.